Selling options is being paid to be patient. Why would you go to the marketplace and pay retail price for a stock? You don't actually have to do that. You probably don't even realize it. Do you want to pay retail price for anything? When you go buy a car, do you just pay the sticker that's on the window? No, you want a deal, right? Selling puts is the exact same thing. It's as easy as this. Choose a stock that you like, choose the price that you want to buy it at, and then sell a put that expires next Friday and collect cash in your pocket. That's it. If the stock goes down, you buy it at the price that you demanded ahead of time. If it doesn't go down, you don't buy the stock, but either way, you keep the cash. Listen, if you're trading stocks and you are not trading options, man, you are literally missing the boat. Now, I'm going to walk through in this video how easy it is. I'm going to show you using my Thinkorswim platform how to choose the stock, how to choose the strike price, the price at which you're going to pay for the shares if it drops below that price, and the expiration date. I'm going to show you everything. You can literally do exactly what I'm doing. Man, I don't work. I just trade options. Now, before we jump right in, hit the subscribe button in the bottom right. I am literally putting up a video every single day for 1,000 days. Okay, let's jump right in. Okay, guys, we're going to walk through trading Nvidia. Nvidia is a powerhouse company. It's not just a chip stock. It's an AI innovator. It's in all the big funds. They did a 10-for-1 split about a year and a few months ago. They just recorded record profits, about $57 billion in quarterly revenue. And the stock right now is trading at $180, $180.26. Now, like I said a moment ago, if you like this stock as an example, don't just go to the marketplace and buy 100 shares at the retail price of $180. No, sell a put on it. So here's how you do that. Here are expiration dates. This is called an options chain. So you choose what date you want the contract to expire. Now, usually I go out 1 week. In this example, I'm going to show you December 12th. It's about 2 weeks away. And down the middle, we have strikes. So the strike is the price that you're committing to buy the shares, but only if the stock drops below that price before the contract expires. So instead of buying 100 shares at 180, how about buying 100 shares at 170? You can sell a 170 put expiring December 12th, and this contract last traded for $245. What that means is $245 gets dropped into your account right now. You don't have to buy stock and hope and pray and wait for some future time frame to sell it to see that profit. No, you get paid right away. And you keep that amount of money no matter where the stock goes. So one of two things is going to happen when the contract expires December 12th. Nvidia will be higher or lower than $170. If it's higher than $170, you don't buy the shares, but you still keep the $245. If it's lower than $170, you buy the stock that you like already on sale. Now let's calculate our rate of return. If you were to get paid $245 and you're putting up $17,000 in capital, if you're not using margin, because it's a $170 strike. So $170 times 100 shares is $17,000. You're literally making almost 1.5% on your money for 2 weeks' time. If you were to do this every 2 weeks, I'm going to multiply by 26. You can literally create an annualized rate of return of over 37%. And worst case scenario, the stock drops a lot, $10 per share, and you buy it on sale. Then, if you do have to buy the shares, you turn right around and sell a covered call against it. Let's walk through that as well. Let's say you already have 100 shares and you pay the retail price of $180.26. If you were to sell a $182.50 call that expires the same date, December 12th, well, that last traded at $520. So if you're paid $520 and you're putting up $18,000 to make the trade because you'd be buying it at retail price, you're literally making almost 3% on your money for 2 weeks' time. If you did that every 2 weeks, you're literally making 75% on your money on a high quality, amazing stock. Do you see how easy this can be? And here's another idea for you. So right now the stock is trading at $180.26. Let's go back and talk about puts again for a moment. Instead of buying 100 shares at the market, you can sell an at-the-money put. So you can sell a 180 put, collect $585, and you're paid to buy the stock. Let's calculate our rate of return in this case. If you're collecting $585 and you're putting up $18,000 to make the trade, you're literally making 3.25% on your money for 2 weeks' time. If we annualize that out, you're making 84% on your money. Now, here's the bonus, guys. Let me talk a little bit about margin, because you don't actually have to use all your money. You can use some money from the bank. For example, if I was to make a trade like this, the easiest way to check the margin is you're going to analyze the trade on the platform, and it's going to tell you what the margin requirement is. So instead of of actually putting up $18,000 of your hard-earned money, you can actually only put up $4,180 to make this particular trade. Now, I'm not suggesting that you open an account and only start it with $4,180, because what would happen is if the stock goes down, you're not going to be capitalized enough, and you don't want to have a margin call and have to liquidate your position and take a loss. But if you had, let's say, $10,000 as an example, you can totally comfortably make a trade like this. And if you calculate the return on the capital required on the margin that you have to put up, you're making $585 and you're putting up $4,180. That gives you almost a 14% rate of return for 2 weeks' time. Listen, if you made trades like this every other week, you're literally flipping your money almost 4 times over. I'm telling you, if you're trading stocks and you're not trading options, you are literally missing the boat. This is so easy, you can literally spend 15 minutes a day. Now, some of you might say, okay, well, what happens worst case scenario? Well, the worst case scenario is, let's say Nvidia goes bankrupt, you lose all your money. So there is risk in the stock market. I'm not here giving you specific recommendations. I'm just here to educate you and show you how you can choose the stock, how you can choose the strike price, how you can choose the expiration date, and how easy it can be to create income for yourself on a regular basis. The strategy that I use is I only trade stocks that I really, really like. So if the stock drops in value, I sell another put as it goes down. I collect more money again, and if I had to buy those shares, if the stock continues to decline, I end up averaging my cost down. And here's what happens with stocks. Let's just take a look at the stock chart. Any stock chart that you look at, it goes up, it goes down, it goes up, it goes down, it goes way up, it went down a little bit, it went up a bit, it went down a little bit. Over the long term, it goes up. Here's a stock chart of Nvidia since 2020, and you'll see it was kind of steady, went up, went down, but over time, it goes significantly up. Good quality companies go up over time in the stock market. That is a fact. So guys, how'd you like that video? Can you totally see yourself doing this? Listen, I spend literally 15 minutes a day putting trades in or checking my portfolio. I sleep comfortably at night. When I go somewhere, I don't have to be checking my phone and checking my positions. No. If you're not trading options, you literally should be. If you want more information, check out the links. I'm going to put some links to some longer videos below. Subscribe to the channel. I'm putting up a video every day. Make sure that you're in my inner circle. I'm building really cool applications, and then you'll be the first to know when they get released. Anyway, I hope that helps. Happy trading.